Hello students. Today I want to just provide a little overview on the balance sheet, and we're going to go through each of the sections and provide you with some additional information that will help you better understand the balance sheet. The balance sheet is one of three fundamental financial statements and is key to both financial modeling and accounting. The balance sheet displays the company's total assets and how these assets are financed through either debt or equity. It can sometimes be referred to as a statement of net worth or a statement of financial position. The balance sheet is based on the fundamental equation of assets equal liabilities plus equity. Assets, anything that's owned by the business. Liabilities, any debts that are owed. And equity, the difference between assets and liabilities, is what remains for the owners. I want to take you to Exhibit 2.2 in the Friedson and Alvarez book, and we're going to take a look at a balance sheet. This is actually a balance sheet for Starbucks as of September 27, 2009. And that's the first thing to point out, is that balance sheet is like a picture of what the company is worth on a specific date in time. Typically, balance sheets are constructed at the end of the month, the end of the quarter, end of the year. But here you see one on September 27th. You could, pick any day of the year and develop a balance sheet. The other thing I want to point out is the numbers stated here are in thousands. So to get the realistic numbers here, we would need to add 3 zeros to what is shown to get the actual number. So let's take a look at the asset section first. Again, assets, anything that are owned. Two types of assets: current assets, which are readily convertible to cash, usually within a year, and then long-term or non-current assets. Those are assets that would take more than a year to convert to cash. Current assets are listed in order of liquidity, with cash and cash equivalents being the most liquid, so it's listed first. Cash would be bank accounts, checking accounts. If you're a retailer and you've got cash in your registers, that would all be considered cash and cash equivalents. Short-term investments available for sale. Those are stocks and bonds and securities that you intend to sell within a short period of time to make a profit. Short-term investments trading securities are similar, only that you intend to hold them for a little bit longer. Your intent isn't to sell them right away. And then accounts receivable, those are all the accounts where people owe you money. They've purchased from you utilizing your credit terms. Net means that it is net of an allowance for bad debts. Unfortunately, when you're in business and you sell to people on credit, there are always going to be a certain percentage of customers who are not going to pay you in a timely manner or not pay you at all. And so this net means that they have subtracted out an allowance for bad debts that they anticipate. Inventories, that would be any merchandise that you hold in storage in your warehouse that is not yet sold. Prepaid expenses and other current assets, those are expenses that you paid for in advance. Maybe you have an insurance policy that you pay 6 months at a time. Well, if you've only incurred 1 month worth of expense, then the other 5 months would be prepaid in advance. Deferred income taxes, those are taxes that you anticipate paying but you have not yet paid. And so then we have total current assets. So these are the most liquid assets for Starbucks. Underneath total current assets are your non-current assets, or also known as long-term assets. Those are things that would take longer than a year to convert to cash. So we see here long-term investments available for sale. Perhaps the company has stock in another company, or publicly traded stocks that they intend to hold for a long time. Those would be listed under long-term. Equipment or equity and cost of investments. Again, that could be investments in subsidiaries, ownership of other companies. You've got property, plant, and equipment. Property, plant, and equipment. All of those hard assets, tangible assets that you can touch, equipment, buildings, vehicles, forklifts, anything of that nature would be here. And again, that's listed net, which would be net of depreciation that's been recognized on those particular assets. Other assets would be things that don't necessarily fit in the other categories. Intangible assets are assets that you can't touch. So, any patents, any licenses, any intellectual property would be listed here. And then goodwill. And goodwill is when a company buys another company for more than the value of the hard assets. That difference is listed as goodwill. You're buying customers, you're buying the business, maybe operational methods. All of those things that you can't touch would be an intangible asset called goodwill. So total assets for Starbucks at that point in time, again, stated in thousands, we would add 3 zeros. So that would equate to $55,768,000 of total assets on that particular date and time. Now let's move to the liabilities and shareholders' equity section. Again, liabilities, anything that is owed. So we have current liabilities. Those are things that need to be paid within the year. Commercial paper, or sometimes large corporations will borrow using commercial paper, usually 90-day notes. Here you see Starbucks doesn't have any of that. Accounts payable are debts owed to creditors. So if they have financed inventory, any money they owe on short-term debts from vendors would be under accounts payable. Accrued compensation and costs. So this would be compensation that they owe that they have not yet paid. They've incurred it, so they're accruing it, but they haven't yet, cut a check for it. That would be listed here. Same thing with occupancy costs. That would be rent that they've incurred, but they have not yet paid. Taxes that they've incurred, but have not yet paid, are recognized as liabilities. Insurance reserves. They must do some self-insuring here, and so reserves that they owe or they anticipate paying out in the future, listed as a liability. And then other accrued expenses. Again, anything accrued is an expense that has been incurred by the corporation. It just has not been paid yet. Deferred revenue would be income that they have received, but they have not yet delivered the service or the product for that income. So they owe that product or they owe that service, and until they deliver it, they are not recognizing that revenue. So they owe the product or service, and that's deferred revenue. Current portion of long-term debt. If they have long-term debt that they've taken out, they're going to make payments during the next year. The part that is attributed to being paid in the next year would be the current portion of the debt. So then we've got total current liabilities, and then they list their long-term. They've got long-term debt. That could be a bank loan. It could be a bond, anywhere that they've borrowed money for more than a year. Other long-term liabilities, and total liabilities of $25 billion if you add the 3 zeros. Then let's move to stockholders' equity section. They have issued common stock, and the amount that was paid in is listed here. Additional paid-in capital beyond the par value of the stock is listed. Other additional paid-in capital. Retained earnings are all the profits that have been retained by the corporation. In other words, they haven't paid it out in dividends. They've retained it for future use. and then other comprehensive income that they have retained. So you've got total stockholders' equity. We had the 3 zeros of $30 billion. Bottom line is the total assets equal total liabilities and stockholders' equity. Again, that goes back to the basic accounting equation. A couple other points I want to make about the balance sheet and financial statements in general. Oftentimes, there will be account line items that maybe you're unfamiliar with, and some companies use slightly different terminology. If you utilize the MB512 resources page that's posted in Moodle for you, one of the resources is Investopedia. And Investopedia is a great tool to use to better understand financial statements, accounting terminology, and a lot of videos and articles available through Investopedia. So I highly encourage you to use that as a resource, as well as some of the other resources listed on that resources page. The other thing I want to point out here, these percentages. One of the best ways to analyze financial statements is to break the numbers into percentages and compare percentages over time or with other companies, rather than just comparing raw numbers. So here, for example, each line item, if we take this cash of $599.8 and divide that by total assets, 10.76% of the company's assets are in cash and cash equivalents. Short-term investments available for sale, take that 21.5 divided by 5576.8, and that would give us less than 0.5%, 0.39%. And we would do that with all these line items, and bottom line is these percentages then will equal 100% of total assets. This just shows how the company has their assets allocated between different line items. And where this becomes useful is we can look at and spot trends over time. If we were to analyze Starbucks balance sheets over 2 or 3 years, we could look for trends that way. We can also compare to similar companies and find out how Starbucks compares to Dunkin' Donuts and McDonald's and other companies that are coffee retailers. We can do the same thing with the liabilities and shareholders' equity section. We would just take each line item, so in this case accounts payable, 267.1, and we would divide it by total liabilities and shareholders' equity, and that would give us the 4.79%. So I hope this little overview of the balance sheet has been helpful. You can refer to it as well as your resources and your book to help you get a better grasp on the balance sheet and how to analyze balance sheets between companies.